Blake Waggoner with Keel Point, and I want to share a few thoughts with you today about tax season, what we as advisors are paying attention to, and how to avoid some common oversights. First, I need to start off with a caveat, which is that Keel Point does not provide tax, legal, or accounting advice. These are just some high-level thoughts on our approach to tax season. So to start out with, the theme you'll be hearing kind of throughout the video today is communication. Communication between an advisor, the client, and their accountant is really key so that everyone is in the loop and coordinating on all the information that they need to know. You can't just assume that a client and the accountant can accurately report everything that happened in the year based just on the tax documents they received without having the full context, which those documents can't always provide. Some strategies require a little bit more information in order to accurately document what happened. Even some strategies that are pretty straightforward and simple to document, it's still key that the tax preparer at least know that the strategy was utilized, and that doesn't always happen. So communication is the theme here. Another quick note is that it's probably too late to be doing much strategizing for the prior year taxes that you're currently filing. There's a few things you can do up until the tax filing deadline, but for the most part, most things have already happened. They're already set. It is a great time to be strategizing and proactively planning for future years and think, what can we do differently in next year to put ourselves in a better tax situation? So to start out with, I want to cover something that's pretty simple, but still is easy to misunderstand, and that's just itemized deductions and the standard deduction. So each year, you basically get to choose either the itemized deductions or the standard deduction. Standard deductions have gone up in recent years. They're relatively high. For a married couple, it starts at $32,200, and for a couple who's 65 or over, it can approach $50,000. So a pretty high number. Itemized deductions consist of basically three things, which is gifts to nonprofit organizations, state and local taxes, and mortgage interest. There are some other deductions that are out there, but they're less common. So for most people, those three things really form the bulk of your itemized deductions. So what you do every year is you compare those two and you take whichever one is larger and you kind of drop the other one. So for people who can quickly determine that my itemized deductions, those three things, are not going to add up to be more than my standard deduction, which is pretty high, then you don't even need to worry about itemized. You don't have to go through the hassle of it because you're basically just going to toss those things to the side anyway and take the standard deduction. On the other hand, if you can see, oh, there's a chance I could be above the standard deduction, then it's really important to be thorough in documenting any potential deduction that you are eligible for, to be sure you're getting the full tax benefit of that, and to be sure that your tax preparer knows about all those deductions. So I want to cover a few specific strategies where the tax documents on their own are not enough to give the context, and you could end up having that not properly documented. You could end up overpaying in taxes just because everyone didn't properly communicate on what happened. Remember, the custodian who prepares the tax forms, they only report the information that they can verify. It is ultimately the responsibility of the taxpayer and the tax preparer to accurately document and report everything. That's not the job of the custodian. So in other words, it's not their fault that the tax documents on their own don't tell the full story. That's really where I view the advisor's role coming in to be that middleman, to be proactively communicating and coordinating, to be sure that everyone is in the loop on the strategies that were used, and to be sure that everyone has the full context they need in order to properly document those things. So first strategy I want to cover is a backdoor Roth contribution. The key here is that if you properly do a backdoor Roth contribution, it shouldn't really have any tax consequences. It should not, the conversion you do as part of that process should not be taxable, or most of it should not be taxable, I'll at least say. But the 1099-R that you get will report the entire conversion as taxable because the custodian, again, can't verify that it was not taxable, because in order for it to not be taxable, they need to know for sure if you had any tax-deferred IRA assets, but they can't know that. You could have had it with a different institution that they were unaware of. So to be on the safe side, they just report the conversion as taxable income. And if you just give that to your tax preparer without the full context of what you were doing, they'll report it as taxable, when in fact most or all of it was probably not taxable if you were properly doing the backdoor Roth contribution method. Another topic is qualified charitable donations, or QCDs. These are gifts made from an IRA directly to a nonprofit organization. You have to be 70 and a half or older in order to do this, and you have to have tax-deferred IRA assets in order to do this. Again, just like the backdoor Roth contribution, the key here is that the 1099-R that you get will report the QCD gifts as taxable income. But if they were done properly, they're not taxable income. You should not report them as taxable on your tax return. But if your accountant doesn't know the full context of what you did, they'll just document it on your tax return as reported, and you'll end up paying too much in taxes. Next is donor advised funds. So the key here is just understanding what is deductible and what is not deductible. For a donor advised fund, what is deductible is when you contribute to the donor advised fund, not when you make gifts from the donor advised fund out to individual charities. So you want to use those contribution confirmations of what you contribute to the DAF to show what goes into your itemized deductions. You don't want to report all the gifts you make as also being itemized deductions. That would kind of be double counting. So even though those organizations might send you tax receipts and call it a tax deductible gift, that doesn't mean you can claim it again as an itemized deduction when you've already claimed what you contributed to the donor advised fund as tax deductible. So it's just an easy thing to misunderstand. It's important that everyone understands what was going on there. Next is SEP IRA contributions. And the key here is just understanding what year the SEP IRA contribution was for, because custodians don't always allow you to distinguish if the contribution you're making is for the prior year or for the current year. And so many custodians will just always report that as being whatever calendar year the contribution was made in. They'll report it for that year, when in fact you may have been making a contribution intended for the prior tax year, but the Form 5498 won't reflect that. So it's important that you communicate with your accountant to be sure that they understood which year you are making a SEP IRA contribution for. Next is being sure that you are not exceeding certain income limits that allow you to fund different types of retirement accounts. The common mistake here is when people don't give their financial advisor the full context of their income and all their income sources. And if they don't do that, then their advisor might say, hey, you should contribute to this account. It'd be a great thing for you to do, not knowing that based on your income, you're not actually eligible to contribute to that account. But they didn't know that because they didn't have the full story based on your income. So really, you want to be sure your accountant is fully aware of all the contributions you're making to retirement accounts, and you want to be sure your advisor is fully aware of your income situation instead of kind of segregating that information. Next is 529 college savings plans. So the key here is you won't actually get any sort of official tax form to document this, but it is 529 contributions are deductible at the state level if you live in a state with state income taxes. Up to $10,000 per year for a married couple is deductible, but you've got to remember that you did that because you're not going to get any sort of official tax document. You've got to just rely on kind of your year-end statement for those 529s. In order to claim that deduction on your state taxes. It's a very easy thing to forget and kind of lose the tax benefit. Next is scholarship granting organizations. These are allowed in 21 states, and they're basically ways that allow you to take your state income tax liability and donate it directly to a private school. Really cool programs. And if you make that type of donation, you get a state tax credit, not just a deduction, but an actual state tax credit for the amount that you donated. But again, if you forget you did that, if it's not properly documented, you'll lose the whole tax benefit. It's still a great thing to do, but you've lost the tax benefit of doing it if you don't remember to accurately report that on your taxes, or to inform your tax preparer that you utilize a scholarship granting organization. Next is HSA contributions. And specifically here, I'm thinking about non-payroll HSA contributions. If it's not being funded through a payroll department, but you're just writing a check to fund that HSA, then it's easy to forget that you did that and not claim the tax benefit, the deduction that you are entitled to for funding that HSA. So that's another easy one to miss. So in summary here, communication is key. You want to be sure all the key parties involved in your financial life are informed, in the loop, and communicating with each other. Sometimes the tax documents on their own Don't tell the whole story. If you're not sure what some of these strategies I talked about are, or if there's something you should be utilizing, I'd encourage you to talk to your financial advisor. Have a good day.